Hey everyone, welcome back to Corporate Decoder. Today, Datum 1 Series Trust just filed their N-CSR and annual shareholder report, and I am seeing some interesting details about their investment strategy. Quick note, this is not financial advice, just my take on public filings for educational purposes. This report dives deep into how-to funds. Polar Capital Emerging Market Stars Fund and Polar Capital International Small Company Fund performed and what drove their results. This document is essentially a report card for investors, showing how the funds have been doing over the past year, ending the 31st of March 2026. It tells us about the investments they made, how much they earned, and what it cost to run the funds. We will focus on the two main funds mentioned in the report. Let's start with the Polar Capital Emerging Market Stars Fund. This fund aims for long-term growth by investing in companies in emerging markets, which are countries that are in the process of developing their economies and markets. Think of places like China, India, and Brazil. The report highlights that this fund did quite well, returning 31.72% over the period. This is actually better than its benchmark, the MSI Emerging Markets Net Total Return Index, which returned 29.55%. That means the fund outperformed its benchmark by about 2.17% after accounting for fees. The managers attribute this strong performance to their focus on technology, especially in Taiwan and South Korea. The artificial intelligence or AI theme really paid off, with big gains coming from companies involved in semiconductor testing, memory and foundry integrated circuit design, and power solutions for data centers. However, not everything was rosy. The report mentions that India was the weakest country in their emerging market universe during this period. High prices for stocks, slowing growth, and investors shifting their focus to China all led to stocks there underperforming. The fund managed this by holding a smaller position in India, which helped, but they still saw some individual stocks struggle. They also noted weakness in internet-related businesses across emerging markets, with investors seeing them as being negatively impacted by AI. The fund managers, however, disagree, believing many of these businesses will actually benefit from AI. They think companies that can manage complex operations like e-commerce, physical delivery, and secure payment systems have a strong advantage that AI cannot easily replicate. Looking at the long-term performance, the fund shows an average annual total return of 1.65% since its inception on the 30th of December 2020. While the most recent year was strong, longer-term returns have been more modest, especially compared to its benchmark, which shows a 3.99% return since inception. This is something investors should definitely note past performance. Even recent strong performance does not guarantee future results. As of the 31st of March 2026, the fund had net assets of over $188 million. It held 57 different investments, which is a relatively concentrated portfolio. The total advisory fees paid amounted to over $1.1 million. The portfolio turnover rate was 54%, meaning about half of the fund's holdings were bought or sold during the year. This suggests active management and a strategy that involves making changes to the portfolio. Geographically, China represents the largest portion of the fund's assets at 25.1%, followed by Taiwan at 20.6% and South Korea at 16.1%. India makes up 10.6%. These allocations show a clear focus on Asia, particularly in the technology hubs of Taiwan and South Korea, and a significant exposure to China. Brazil, Hong Kong, South Africa, and Vietnam round out the top 8 geographical allocations. Now, let's look at the Polar Capital International Small Company Fund. As the name suggests, this fund focuses on smaller companies outside of the United States. Small companies or small cap companies can offer higher growth potential, but also come with greater risk, because they are often less established and more sensitive to market changes. Interestingly, the description of what impacted this fund's performance is almost identical to the Emerging Market Stars Fund. It says the fund returned 31.72% compared to its benchmark, the MSI Emerging Markets Net Total Return Index, which returned 29.55%. This means it outperformed by 2.17% after fees. The report also repeats the narrative about technology, AI, Taiwan, and South Korea being strong contributors, and India being the weakest country. This strong similarity in the performance commentary between two funds with different investment focuses raises a flag. It is unusual for a small cap international fund to have its performance driven by the same exact factors as an emerging market fund, especially when their benchmarks are different. The performance data here is quite striking and frankly concerning. For the year ended the 31st of March 2026, the Polar Capital International Small Company Fund returned a negative 7.90%. This is a significant underperformance compared to its benchmarks. The MSI ACWI XUA Small Cap Index returned a positive 27.82%, and the MSCI ACWI ex-USA Investable Market Index returned a positive 25.32%. The fund also performed poorly since its inception on the 30th of September 2024, with a negative 14.62% return, while its benchmarks show positive returns of 18.79% and 21.10% respectively. This consistent underperformance suggests there might be a fundamental issue with the fund's strategy or execution compared to its peers and benchmarks. As of the 31st of March 2026, this fund had net assets of just over $115 million. It held 52 portfolio holdings, which is also a concentrated portfolio. Advisory fees paid were over $1.1 million. The portfolio turnover rate was 70%, indicating very active trading. A high turnover rate can sometimes mean higher transaction costs, which eat into returns. Geographically, Sweden makes up the largest portion of this fund's assets at 18.7%. This is followed by the United Kingdom at 13.0%, Japan at 11.8%, and France at 9.9%. India is at 9.2%, and Germany at 8.3%. This allocation shows a preference for European markets, along with exposure to Japan and India. Now let's look at the financial statements themselves. The statements of assets and liabilities show the financial health of each fund at a specific point in time, the 31st of March 2026. For the Emerging Market Stars Fund, its investment securities were valued at over $186 million. They also held about $2 million in cash and other assets. On the liability side, they had around $868,000 in payables and accrued expenses. This gives them total net assets of almost $189 million. For the International Small Company Fund, its investment securities were valued at just over $113 million. They had about $1.1 million in cash and other assets, and liabilities of about $603,000, resulting in net assets of nearly $115 million. Interestingly, the International Small Company Fund had distributable earnings of a large negative number over $21 million. This means it has lost money that would previously have been distributed to shareholders. The statements of operations show how the funds performed financially over the year. For the Emerging Market Stars Fund, investment income from dividends and interest was about $2.17 million. Expenses, including advisory fees, fund accounting, and administration, totaled around $2.3 million. However, the advisor waived and reimbursed over $541,000, bringing net expenses down to about $1.76 million. This resulted in a net investment income of over $405,000. The real story for this fund is the net realized and unrealized gain on investments, which was a massive $46 million. This is what drove the overall net increase in net assets of over $46 million for the year. For the International Small Company Fund, investment income was much lower, around $837,000. Total expenses were about $1.8 million, but after a waiver of $150,000 from the administrator and over $181,000 from the advisor, net expenses were around $1.47 million. This resulted in a net investment loss of over $640,000. The big takeaway here is the net realized and unrealized loss on investments for this fund, which was almost $15 million. This loss combined with the investment loss led to a net decrease in net assets of over $15 million for the year. This directly reflects the underperformance we saw in the performance data. Looking at the statements of changes in net assets, we see how the net assets of each fund changed over the year. The Emerging Market Stars Fund saw a significant increase in net assets of over $34 million for the year ended the 31st of March, 2026. This was driven by the strong performance and also by new capital coming into the fund through stock sales and reinvested dividends. On the other hand, the International Small Company Fund experienced a net decrease in net assets of over $15 million for the year. This is a direct result of the losses we just discussed. While they did have significant capital coming in from stock sales, the investment losses were too large to overcome. This is a common pattern with underperforming funds. Capital flows out as investors react to poor returns. The financial highlight section provides a per-share breakdown of performance. For the Polar Capital Emerging Market Stars Fund, the total investment return for the year was a healthy 31.71%. This aligns with the numbers we saw earlier. However, for the Polar Capital International Small Company Fund, the total investment return for the year was a negative 7.90%. This is quite alarming for a fund focused on small companies, especially when broader indices are showing positive returns. The ratio of expenses to average net assets after waivers is 1.10%, which is reasonable, but the actual investment performance is what is really dragging it down. The notes to the financial statements provide crucial context and explanations. They explain how the funds are organized and managed. Both funds are part of the Datum 1 Series Trust and are investment companies registered under the 1940 Act. They are described as non-diversified, meaning they can invest in a smaller number of companies than a diversified fund, which can lead to higher volatility. The notes detail how securities are valued. Equity securities are generally valued at the closing price on their principal exchange. If there is no trading that day, they use the latest available quotes. The report also mentions that they use Level 1 and Level 2 inputs for valuation. Level 1 uses quoted prices in active markets for identical assets, while Level 2 uses observable market inputs. For foreign securities, they might use pricing services to adjust values based on market movements between the close of foreign markets and the New York Stock Exchange close. Crucially, there are no Level 3 securities, which are those valued using significant unobservable inputs. This is generally a good sign, as Level 3 assets can sometimes be harder to value and more prone to subjective judgment. The report also outlines the risks involved. For the Emerging Market Stars Fund, there is a significant discussion about the risks of investing in China, including political, regulatory, and economic uncertainties. They also mention Stock Connect investing risk, which is how they access Chinese as shares. This involves navigating a relatively new program with potential limitations on trading and tax rule changes. For the International Small Company Fund, the primary risk highlighted is small companies investing risk. This means investing in smaller companies generally comes with greater risk than larger companies. They mention that smaller companies can have more volatile earnings, higher failure rates, and less liquidity, meaning their stock prices can be more sensitive to selling pressure. This is a really important point. When a fund consistently underperforms its stated benchmarks and peers, it raises questions about the investment strategy or the execution of that strategy. For instance, when Kodak did a 1-for-20 reverse stock split in 2021, its stock price eventually declined another 40% over the next 90 days. While this is not a reverse split, the persistent underperformance is a strong negative signal. A $1,000 investment in the International Small Company Fund in this period would have lost about $79, whereas a similar investment in its benchmark MSCI XUI Small Cap Index would have gained over $278. The Board of Trustees approved the continuation of the advisory agreements for both funds. For the Emerging Market Stars Fund, the advisory fee is 0.90% with an expense limit of 1.00%. For the International Small Company Fund, the advisory fee is 1.00% with an expense limit of 1.10%. The board considered performance, fees, and services provided by the advisor. They noted the Emerging Market Stars Fund's strong recent performance and felt the fees were reasonable. However, for the International Small Company Fund, the board reviewed its underperformance compared to its peers and benchmarks. Despite this, they approved the continuation of the advisory agreement, citing the advisor's management of operations, legal, compliance, and distribution. This is a somewhat concerning outcome given the significant underperformance. It suggests the board is prioritizing the overall management structure over the direct investment results for this particular fund. The report also includes an opinion from Deloitte and Touch LLP, the independent auditor. They state that the financial statements for both funds present fairly, in all material respects, their financial position and results of operations. This is a standard clean audit opinion. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. Like, comment, subscribe, and join our Discord community.